This is Eat, Sleep, Invest, the marketing podcast for real estate investors to get more deals.
Hey, welcome back, everyone, to another episode of Eat, Sleep, and Invest. I'm your host, Brian Driscoll, and I'm here with Ian George. What's going on, Ian?
Not too much. How are you today?
Hey, doing well, thanks. So everyone, listen, I've known Ian for a long time. Ian knows a lot about life insurance. So, Ian, give everybody a little background on what you do.
So when people ask me what I do, I say I'm an asset protection specialist. And I focus on using strategies of life insurance and other forms of protection to help maximize people's wealth, both living and for legacy plans. So not only what you have, maximizing what you can do today, but maximizing what you're leaving behind, right? So that's where I spend the vast majority of my time. And that actually can include, for example, income maximization in later years. I don't like to use retirement because a lot of my clients don't really stop. But what it means is that they want to spend, so they want to start spending some of the assets that they've, been accumulating and not depend so much on the other assets that, whether it be a job, whether it be their investments, and have strategies to protect those as well.
Okay, cool. So basically, you're talking also like in retirement, creating ways that people can pull money out. Say the market dips, things like that. They have other places to pull cash from.
Correct. Yeah, and there's a lot of stuff, and there's a lot of stuff going on today that people want to build a small pension for themselves. Well, how do you do that? Well, the truth is to build a small pension for yourself and to protect everything, you're going to want to have life insurance be part of that as well.
Right. So, okay, and just everyone listen, this isn't going to be a pitch fest either. We're just talking like about the basics and how things can benefit you if it's in your situation. So, Ian, give us the different types of life insurance that are out there.
Well, the good news is when a lot of people get overwhelmed because insurance companies in the industry has done a great job of creating God knows how many different names of life insurance contracts. But there are three basic chassis upon which all life insurance policies are built. Everybody should know term life insurance, which is straight. That's the easiest thing to think about. Term life insurance is pure risk. You pay X amount of dollars, that's your death benefit. There's no cash value, there's no nothing. You don't pay your premium, policy lapses, nothing goes on a credit reporting like that. You just don't have life insurance anymore, right? Those policies, generally speaking, are written with guaranteed premium levels, 10, 15, 20, 30 years. And that's when your premium is guaranteed for those numbers of years, right? So people lock that in so they can, lock in that protection. Term life insurance is the lowest cost in terms of premium to death benefit because, again, it's pure protection. Then you have the easiest way, it's not chronological, but the next easiest one to explain is universal life insurance. And universal life insurance is basically the marrying of a cash value to a term life insurance policy. So you do have your internal term policy costs associated with the universal life policy. And then next to that is some sort of cash value chassis, right? So that when they first built those in the 70s, it was in an interest-bearing account. Then interest rates went way down. Nobody liked that anymore. So what was running later on in the 90s was investment accounts. So variable came in. And basically what happened is in that account became mutual funds. They're called sub-accounts anytime an insurance company touches a mutual fund, but it's a mutual fund. So they were investing in that. There was a little bit of volatility and some issues with that as well, as we all know. I mean, people all remember 2008, but actually if you go back to 2001, 2, and 3, those weren't great for those policies or the market, either. So there's different aspects of that because when the cash value of those contracts isn't building the way you want it to build, you can have increasing mortality charges, the cost for the life insurance, so they can start to be a little wonky. And then nowadays, the most popular version of universal life insurance is indexed universal life insurance. And it's actually the most complicated product that exists today. But it's essentially based on futures purchase, if you will, on a given market. So you're buying, the performance of an index that's translated into an interest rate. So for example, you're buying the S&P 500, but your money's not going into the S&P 500. It's basically being translated into an interest rate from a year over year or year over two, year for 2 years for 1 year. Like I said, it's pretty complicated. But again, that's just the cash value side.
Hey, Ian, now you're talking on universal life. Explain a little bit about it being wonky with your premiums may stay level, but the mortality rates go up.
Yeah, so with universal life insurance, what happens, remember, it's a marrying of a term life insurance policy with a cash value vehicle. So whatever that cash value vehicle is, and there's two things that fund any kind of cash valued life insurance, right? The first thing is, are your premiums. So you're putting your premiums into the bucket. And then the other thing are your earnings that go into that bucket, right? Now, in a universal life policy, what's happening is that money's going into that bucket, and it's there to be slowly drained for the cost of the insurance that you're buying, right? So each year you're getting older, and the cost of life insurance, the cost of the term policy, is going up a bit each year, right? Now, between the ages of 35 and 45, do you see big increases in the term cost? You don't, because the mortality charges, basically the odds of a 35-year-old dying, are lower than that of a 45-year-old dying, but they're both pretty low. Where you see those odds starting to really change is when you get people into their 60s and 70s and things like that, and suddenly you start to see that the internal charges on the contract have become greater because now you're buying this death benefit on a 60-year-old or a 65 or a 70-year-old, right? So what can happen if they're not monitored properly and strictly is that those charges can start to chew away the cash value faster. Because remember, that investment bucket, whatever it is, whatever that cash value bucket is there to fund, built by the insurance company to fund and draw out the premium for the death benefit. So as those expenses grow, essentially think of it as there's a hole in the bucket to fund the life insurance, and as you get older, that hole is getting larger. So if the cash values don't perform as you expected or they were projected or something along those lines, you could end up in a scenario where, in your 80s, suddenly there's no more money in the bucket because it was all drained down to cover the expenses of the policy. Policyholders get, that horrible statement of, hey, you owe this big chunk of money, which is now you're just buying the term insurance on like an 85 or an 86-year-old, which you can imagine pretty high.
And now people can order projections, in-force illustrations to see how theirs is going to play out, right?
You can order there's a lot, again, with universal life insurance, there are a lot of levers, right? So for example, you can adjust from where it is today. So you can order what's called an in-force illustration and say, hey, I want to see this. And then you can ask for whatever you want that interest rate to be, right? So for example, somebody may have been, chose to purchase a universal life insurance and the interest rate being shown was, 7. So let's say it hasn't really done 7, since they've owned it. And they say, hey, if they're ordering an in-force, and I would recommend that they use a professional for this to kind of coach them through what they're ordering. Because, so for example, if I was ordering an in-force illustration today, I might ask for it at 5, depending upon the style of product, to see, hey, let's test it a little bit. Because the other thing you can do is you can reduce the death benefit, right? So if you bought a death benefit of $1 million, and that creates the strain on the policy for, what it costs to fund $1 million, if you reduce that death benefit, you could reduce the size of that hole, right? So it all depends on how people are using it. The language within universal life insurance is kind of all over the map. Like every company has their own build because it really is not unified. So for example, everybody's term life insurance looks the same, right? It's we charge X, and if you die, you get Y. That's the deal with term life insurance. There can be some, return of premium and different things like that, but by and large, that's what it is. Universal life insurance, Insurance companies have gotten very creative with all the different ways. And that's not necessarily a bad thing, but it can be a confusing thing. So the problem I have with universal life insurance is I often run into clients who have universal life insurance policies that they just don't understand how they work. And that's obviously frustrating. And that can create a lot of heartache when you go to use it one way and you're like, well, it's not going to really behave that way. So the other frustration I have is I've run into a lot of advisors who don't understand how universal life insurance works. And that's because they were trained up and told this is what it does, this is what you can tell clients. And let's put it this way, that's not all exactly, I wouldn't say they're lying, I'm saying they're shortcutting for the sake of making it as simple as they can for someone to understand. Because remember, you're taking what is a complex product and trying to make it simple for somebody to understand.
Right.
And more importantly, want, right? So there's all that affiliated with it. Then there's the third type, which is whole life insurance. And whole life insurance, by and large, today is only offered by mutual companies, right? So your Mass Mutual, Northwestern Mutual, the Guardian, New York Life, Life of the National Life of Vermont. There are others. There's a lot of mutuals out there. Not as many as the stock-held companies that are out there. But whole life insurance is different because it's built in reverse fashion. So what I mean by that is when an insurance company builds a whole life insurance, what it means is they start with a guarantee. So they say, okay, here's Brian, and Brian has got this health rating and he's this age, and he's buying a death benefit of $1 million. What does our premium have to be at our guaranteed rate? So a lot of guaranteed rates right now, because that all changed. It used to be one rate across the board. Now different carriers have different, underlying rates. That was a change in January of 21. But with that, what's the premium we have to charge to guarantee that the cash value meets the death benefit at age 100? So it's built backwards. That's the foundation. That's the underlying guarantee. And that's carved in stone, right? Then what happens is the whole life insurance companies declare dividends. And all of these whole life insurance companies have a dividend history of greater than 150 years. So what happens is as they pay their dividends, the dividends are paid on top of those guarantees, right? So whole life is a much more stable because it's built on that guaranteed chassis. The easiest way I explain it is to say with whole life insurance, because it's built in reverse. In other words, this is the guarantee we're making, and this is what the premium is for that to create this contract with that guarantee, and then dividends are paid on top. That's whole life. Universal life insurance is a lot more like a regular savings/investment, depending upon what's in that side bucket, right? Which is here's what we're gonna charge in terms of here's what's going in, and then off we go and let's see how it does, right? Because the underlying guarantees in universal life insurance only apply to the funding side. It doesn't apply to the death benefit side, the charge, right? So you can have a fixed rate or an underlying guaranteed rate that it can't go any lower than, but there's nothing that has a guarantee in terms of, there is a guaranteed mortality charge, but it's not what they're operating on today. So there's just a lot more variables. And it's not a good, bad situation. It's just a very different situation. You've got a very, old standard whole life build. And by the way, if it's whole life insurance, that's how it's built. Okay. Remember when I said with term life insurance, all the insurance companies have the same basic build? With whole life insurance, here are the rules. This is, if you're building a whole life insurance contract, this is what it looks like.
Right.
There can be some riders and different things you can attach to it, but that base contract, that's how it's built. With universal life insurance, you don't know that. You have to learn that because every insurance company builds a universal life insurance policy differently. every company builds their base whole life the same. Every company builds their term the same. So it's just something that people need to be aware of, because if somebody says, I have a UL, that doesn't, if somebody said to me, I have a UL, is that good? I'm like, I can't begin to answer that question, because I don't know how the company you bought it from, built it. I don't know what it's based on. There's so many variables. I would actually have to get that contract. So it's a very specific conversation. If somebody said to me, I bought a term policy, sure. That's easy. Do you feel like it's a good value? Things along the, if someone said, I bought a whole life insurance policy, I'm like, sure, it's going to do what it said it's going to do. You have guarantees built in there. I don't care what mutual company you bought it from. There are different choices within the mutuals and different things, again, riders and what you can do with cash, but the base contract, all the same. So I can tell you how that's going to operate. Doesn't matter who the carrier is. So that's the differences.
Yeah, that makes sense. So basically, term insurance is cut and dry. You buy $1 million, 10 years, it expires in 10 years, you have nothing. If you die in 10 years, you get $1 million. Whole life, same thing, except it doesn't expire as long as you pay your premiums, but it's going to be usually the most expensive premium also, right?
Yeah, on a pure basis, yeah, what you're putting into whole life insurance, because it's building cash value and it's adding little whole life contracts to it along the way, which is a little bit of a complicated, but it's growing. So yeah, you want to be, and same with universal life, right? Because universal life, one of the things that I love about universal life is it talks about, actually some of the products are called flexible premium or adjustable premium. Well, just remember, with universal life, all you have to make sure is funded is the death benefit, what they're drawing out of that bucket. You can put as much or as little into that bucket as you want, but you just have to have measured expectations about how that bucket's being funded.
Yeah.
Because you can't pay just the mortality charges and expect to have money in that bucket down the road, right? Because you're just paying the expenses of keeping it. You're not putting anything actually that's going to sustain in the bucket.
Right, and I guess that brings up a good point too. It depends on what's your purpose for the policies, right?
For sure.
So say someone's got a partnership, they're doing a flip and they got to do a buy-sell agreement. They may only need a 2-year term versus someone who wants to make sure that their spouse is protected for their entire life might need something more permanent.
Exactly. The other thing too is with, when people are doing, short-term buy-sell agreements, one of the things that people will do, the one thing about buy-sell is that there's a couple of ways to do it. You're protecting, obviously each other against the event of the other person's death. There are a couple of carriers that have very competitive annual renewable term, right? So if somebody wants to, says, I only need this protection for 2 years, they're very competitive rates for what's called annual renewable. So it'll be X 1 year and it'll be a little bit more in year 2. Now, you wouldn't want to keep something like that for more than, say, 5 or 6 years because those premiums are going to balloon. But if somebody says, no, we're out of this deal in 3 years, but we want to have this coverage, that's a very competitive way to do it. The one thing we do also is sometimes people who are inactive, are constantly doing these deals. The other thing you could do is buy a term life insurance policy so you're not reapplying for each new deal. So you may want to buy a term life insurance policy that's a longer. And then what you can do is you could go so far as if you wanted to, you could actually transfer ownership, right? So if you and I are doing a deal and I have a policy and I say, okay, I'm going to transfer ownership of this policy to you and make you the beneficiary while we do this deal. At the end of the deal, you transfer the ownership back to me and I change the beneficiary back, right? So I have this term policy that is for that purpose. It's waiting. The next deal that comes along, I'm going to transfer the ownership and then change the beneficiary for that deal. And what that would mean is that I'm not trying to get underwritten every time. I've got really quick reactions to that.
You know what? That's a good point too, because the average life cycle of applying for insurance to issuing a policy might be 45 days? give or take.
That's a pretty good average.
Yeah.
I mean, a lot of carriers, I would say that we do it in a lot of circumstances. It's gotten very fast, but as soon as there's a medical anything, right? It doesn't have to be major. As soon as somebody's on a prescription or had appendicitis 2 years ago, little things that are not going to impact the policy, but are going to make an underwriter ask more questions. Those are going to be the things that are going to push it out to 30 or 40 days.
Yeah. And it's a pain in the butt too. That is, I never thought of that. You just have a policy sitting there for your flips. When you partner up with someone, put them on as beneficiary. When it's done, you're done. It's just a simple form.
Exactly. And that's where it's funny, because that's also where a permanent life insurance policy can become, advantageous as well. You would use it differently. You don't take your permanent policy and make somebody else the owner of it, but you could put them on as an assignment or as just a beneficiary, right? So you could change that. But the thing about a permanent policy is now there's no, like if you buy a 10-year policy, you know that if you're going to continue doing this in year 11, you're going to want to get a new policy. If you say, I have a 20-year run in front of me, do I want to do a 20-year term and keep that there, or do I want to do something that's permanent? And then what you would do is simply evaluate, how could I, what's the value I have of that cash value, right? Do I like the idea of having that be my savings account, and that this death benefit's here so I can just, have different people assigned or beneficiary for a portion of that death benefit? So there's a lot of ways to structure that so that people can, make what they're doing easier and sometimes more efficient.
Yeah, and the reason, for anybody who doesn't know buy, sell, and why you would even do that, it's like, say me and Ian are doing a deal, and something happens to me. If we don't have anything in place, most likely my wife just became Ian's partner.
Yep.
With no experience in real estate or business. So you can buy the life insurance policy, which buys the other person out, or buys the other person's spouse or whoever would inherit their stuff, right? And then you get complete ownership.
Yep, it's a great piece of protection, and it's a way that people keep everything in line. And I've done it for people who, there are groups that have put together, buying consortiums, right? So they're all coming in, and there's the superstar or the driving force behind those. And that's usually the person who's doing the raise. They're out there asking and say, hey, this is what we want to do. This is what we're going to do. And they're like, great, I'm going to put that money in place and do that with you. They're really buying that person's knowledge and expertise. And if something happens, they'd like to make sure that they're covered. So if the guy that they were funding and who was doing all this stuff, who knew how it all worked and that they already trusted, something happened to them, they'd like the idea that, hey, that bucket's going to get refilled. I'm going to get at least my money back, right?
Right.
And they could build that however they saw fit.
Hey, Ian, what else do you see real estate investors using life insurance for? Like, I know there's a lot of creative things. What do you see as most popular or most common?
Well, the one thing, there's a couple of aspects. So using the cash value of life insurance for down payments and things like that. Now, it takes a little bit of time to build up the cash value before it has the steam to do that. But it's interesting. When I talk to, clients who've had products in place for, say, 7+ years, and you go over everything you can do with the cash value of that contract and the ease and the speed and what goes on with it, a lot of people like to use that cash value to have that in and out aspect of what they can do with that cash value. And you and I were talking a little bit before we, started about, all the bank on yourself, infinite banking, be your own banker type of stuff. And that's really what that comes down to. It's basically building up the cash value of your contract so that you can access it and pay yourself back, right? The idea being, and since, you have a lot of real estate people who are listening, the idea being is that your policy in that particular circumstance is like your real estate. It's just continuing to grow. So whether you're taking loans against it or drawing equity out of it, the policy's value is continuing to grow. It's basically collateral. So for example, if you had a piece of property and you went to the bank and said, I want to leverage this property to get cash, to take a loan out, that property's value is going to increase. The property doesn't know there's a loan on it. It's not going to behave differently or act differently. And that's what all those, all those fundamentals in terms of be your own banker, banker yourself in infinite banking, that's what they all focus in on, is that same idea. Because what you're doing is your cash is in the background constantly earning, and what you're doing is using the insurance company and the way their contract works to access cash on an in and out basis. So you'll hear me talk often about when people talk about whole life insurance. And again, the reason whole life insurance tends to come up in those conversations is because of its stability, right? There's no big swings. So, but the aspect of that is that's what makes the cash value in a whole life contract very, highly liquid, right? But it just depends on, you don't want to buy a whole life contract and then look at it in year 2 and say, hey, I want to hit this for a whole bunch of cash value. Well, it's kind of like I'm going to start a savings account, then I want to go borrow from the bank more than I have in the savings account. They may do a pure loan for you, but they're not going to give you any kind of leverage benefit in terms of the fact that you don't have very much money in that savings account. So it's kind of the same animal.
Right, because in the beginning of policy, a lot goes to like the insurance, commissions, things like that. So you get low cash value in the first couple years, and then it just starts increasing, right?
Correct. And there are policies that are built to have a lot of cash value early on. I mean, there's actually a contract that I do work with called high early cash value, where 85% of the first year premium goes directly into the cash value, right? So you're building it very, very quickly. That's a very attractive type of contract. And there are a lot of contracts that you can build that build up a lot of cash value early and soon. You just want to make sure you know why you're using that and what you're doing for it, because those contracts don't necessarily perform as well as other contracts, 20 years from now. Right? So, and it's fine. You just want to make sure you've got the give and take, and you know what it is you're getting and why you're using it, and that's where the conversation really comes in.
Yeah, and it's important to know too, like you just brought up, there are some policies built for that versus having to go take a product and tweak it and potentially meching it down the road. Actually, tell everybody a little bit about what's mech mean.
MEC stands for Modified Endowment Contract. So what that is in 1988, the IRS basically came down and said, hey, there are a lot of people stealing a lot of money in permanent life insurance policies. And why were they doing that? Well, what's the value of the cash value in a permanent life insurance policy? It's tax protected. It's also protected from suit, right? Now, I know this isn't just for people in Pennsylvania. This is a nationwide podcast. So the protection from suit aspect varies by jurisdiction, right? So you have to make sure you check on that. But in the majority of states, your cash value will be protected from suit, except for the IRS and an ex-wife or ex-husband. So, or nowadays ex-partner, right? So the divorce courts can pierce that seal. And if you think about it, it's kind of like if you think about your 401k or a pension or IRA, those two are protected from lawsuit, again, except for the IRS and an ex. So those rules kind of apply as well. The other thing too, the tax protection with permanent life insurance, there's a lot of ways to access cash value from a permanent policy tax-free, not just deferred, okay? So that's a big attractive aspect. So people were pumping a lot of money in there because they were protecting themselves from future taxation. The IRS came out and said, all right, hang on a second. These things are no longer life insurance policies. These have become, a tax shelter. And that's not what should be happening. So they created limits and they created a test. The test basically, it's called the 7-pay test, but nobody needs to know or worry about that. What they want to know is on a modified endowment contract is this. If you put too much cash value into your policy, too much premium towards cash value into your policy becomes a modified endowment contract, otherwise known as a MEC. Just know that all your growth, when you go to access it, is going to be taxed, right? So And it doesn't matter if you borrow, if you try and take it out as a loan or any other, or partial surrender, which is the other way of taking money out of a permanent policy. If you're taking money out of a policy that's a MEC, it's going to be taxed. In other words, it's going to be treated like an annuity.
Which is huge.
Yeah, it can be bad. I mean, I've worked on scenarios for estate planning cases where the policy is going to be trust owned. In other words, they're only ever looking at the death benefit. And by the way, the modified endowment contract does not affect the taxation of the death benefit, only the access to the cash value. So a lot of those people don't care. They're like, I'm not taking any money out. It's all there to grow the death benefit as fast as I can. So funding, putting a lot of extra funding into it, the fact that it MECs doesn't bother me in the least.
Yeah, and you know what? That just made me think of something too. Say on any permanent policy, whole life universal, you're borrowing money for your policy, buying properties or whatever, and say something happens, you just created a big void in your policy that even on your deathbed, your heirs can fill that back up, right? Or your family or whatever. Like you can put that money back in without anything and bump your death benefit up immediately.
Yeah, well, what you said is on your deathbed, it's important to know that you're still alive.
Yeah, you still got to be alive, right?
So yeah, as a matter of fact, there have been more than a few times I've met with families who I was referred to, who I didn't write the policy, right? The individual, and they said they had in all the cases so far, it's been whole life insurance, where really whole life insurance is where it would matter the most. Universal life insurance, because of that separation, the cash value doesn't usually have that much of an impact on the death benefit unless there's a loan against it. But with a whole life insurance, I've had families where the individual had used the policy for a whole bunch of different reasons, in their later years, and there were loans or partial surrenders and different things like that. We contacted the insurance company and asked them what it would look like if they repaid the loans. And we saw it on a piece of paper. They had the money sitting over there, and the person who was running that person's affairs at the time said, "Oh my God, this is great. Look at the jump I get by putting this money here. It comes out in death benefit. Coming out in death benefit does nice things like avoids probate. The beneficiary's all been worked out. There's all that other stuff already affiliated with it. And usually if structured at all right, it'll be tax-free. So people will take, hey, there's all this money over here sitting in cash, or we have all these gains and different things like that. Let's take that, pay that off. To your point, push up that death benefit and have that come out upon their death. I did one where we actually had the transaction completed, and within, I think it was 2 weeks, the individual passed. So, yeah. But it's nice because you can order the information up front. So it's not like you're pushing money in and saying, let's see what it grows to. You're saying, no, hey, tell us what that would grow to if we did this, and then you make the decision from there.
Right. So say the reason somebody might have a loan on their policy is, say, when they're in their 60s, 70s, things like that, they start using some of the income from their policy to live, which would create a void in that example.
Yep.
And that's why they may still have a void whenever they're ill. And then if you put money in there, you might be getting $3 to $4 back on a dollar. Like if you put $1 into the policy, it might bump your death benefit $3, right? Or whatever it is.
Yeah, I mean, usually it's going to be more like $1.50, $2, right?
Right.
But yeah, I mean, and the biggest point of that is that you would know it before you did it, right? It's not like we're going to see. The other thing too is because of the liquidity and how the money came out in the first place. Let's say you did that, and then you're like, "Oh, we shouldn't have done that. We need that money." Guess what? Take it back out, right?
Right.
So that's where, that's the cool aspects about the flexibility. It's interesting when I talk about, wealth planning and using permanent life insurance, the biggest aspect that permanent life insurance adds to all of this are choices, right? I don't know how somebody is going to use it, but I don't need to. All I do know is it's going to add flexibility and different options to what they can do down the road, right? And you can, go through a whole bunch of scenarios from plain vanilla. Look, you pay into this and you die, your beneficiaries get this. Look, here's how it worked. And that becomes a quick calculation. What was the value of my premiums paid to what that grew to what my family got? You'll find that it's very competitive, right? Especially when you get into the tax treatments, very competitive. Like when you net it all out, you're like, oh, that's pretty good, right? In terms of just its own asset. But then when you add to that I could do stuff beforehand or leverage it. We talked about, leveraging death benefit to create your own pension. I mean, there's, the simple idea behind leveraging death benefit is that if you know X number of dollars is coming in upon your death, that basically gives you permission to use other funds here because you know that it's going to be replenished upon your death. So the way, there's a lot of strategies out there that we leverage death benefit for people to give them all these different choices, but it's all the same leveraging, right? So it's all the idea of like, hey, I know that this comes in upon my death. So the strategies that exist for how you're going to use other assets, to be replenished upon your death by that permanent death benefit are limited only by your imagination.
Yes. So on that, it's like I kind of see that too. You're saying someone in business in their later years, if they only have a certain amount of money left for their wife, if they have this policy already who's going to recreate that, they can make a little bit riskier decisions in business because they know if it fails, their family still has a safeguard on the death benefit.
Correct. Yeah, I'm a business owner, you're a business owner. We all know how our business runs and how it works. Our spouses usually don't have a lot. I mean, they generally know what we do, right? But if they said, hey, to manage this to the effective rate that we manage our businesses, that would make them very uncomfortable, right? So, I've done this. I've seen people have an interest in life insurance policies when markets got, topsy because the value of their business had gone down a bit. They weren't concerned about it. But who was concerned was their spouse because they knew how they, hey, this is a trend. This is what goes on. I'm going to, this came down. I'm going to ride it back up too. I mean, I have my strategies. I know what I'm doing. It's going to be fine. If something were to happen to me before that occurred, would my spouse or who I'm leaving this to be able to do what I would have done to do that? Sometimes the answer is sure. Sometimes the answer is no. They wouldn't feel comfortable doing it. It's a cash out situation. Now it's lower than we would have liked it to have been. So I have the death benefit that gives me the pad, that gives them that comfort, which gives me comfort.
Right. A little bit different topic. How about business owners with their employees? Like sometimes they'll use life insurance as a benefit, right?
Sure.
How's that work?
So there's obviously providing employees with, death benefit is a great benefit. It's appreciated, if people, because, anybody who's ever had a job, has often seen, you get anywhere from 10 to 50,000 or sometimes like one-time salary or something like that in the event of your death that's provided by your employer. And it's nice to have, right? It's, it's real and it's there. You can take that to a whole couple, next degrees, right? Too. So you can provide a benefit for an employee as well as provide key insurance, so protection. So if you have an employee who's really important to you, called key person insurance, right? That if something were to happen to them, it would cause, it would cause you fiscal harm. You could insure that employee so that if something were to happen to them, you get paid. You could do that in conjunction with making sure their family got paid as well. So if something were to happen, you'd have some protection. Their family would have some protection. You can use permanent life insurance in those examples as well, because not only while they're working for you can you use the death benefit to protect you for a key employee and their family, the cash value can also be used as a bonus program or deferred comp program. So that same contract, here's the thing about term life insurance. We know that, and the stats haven't really changed in years and years and years, that the odds of somebody dying on a term life insurance policy is less than 2%. That doesn't mean that term life insurance is invaluable, right? Term life insurance would not be valuable if the odds of dying owning term life insurance was 0, right? So, term life insurance is an important piece of protection because just because it's less than 2% doesn't mean it can't happen. And doesn't mean that we all don't know somebody that had it, that died unexpectedly early and it created havoc. So the value is there. That's not the issue. The good news is that's what keeps the premiums for term life insurance low, right? The risk the insurance company taking is relatively low. But translate that into your working years. The odds of a key person dying while they're working translates to that same kind of term number. It's less than 2%. But you want to have that protection in place. Well, if you use a permanent contract, if cash flow and all the other scenarios, make sense for you, you could use that for the protection, but then also have funded something that's a deferred comp or bonus program for that key employee as well. So you can get some additional use out of it too.
Kind of golden handcuffs, right?
For sure.
Yeah,
and
so you're
however
getting
you
the
want.
benefit. You can say, hey, you know what? You get this in 5 years or whatever.
Yep. Yeah, there's a whole host of different ways to do it, for sure. And they're all pretty straightforward, and most of the time people want to secure them. The funny thing is most, executive comp, deferred benefits, there's all the different names. The reason life insurance comes into play for those so very often is one is the tax aspects or the tax protections associated with the cash values of permanent life insurance. Because if you start investing and saving as a corporate, in a corporate basis, there's a lot of taxation that they're headwinds, right? So as it's growing for what you want to give this person, it's being taxed every year, and that could be a little harsh, right? The other thing too is a lot of times as part of that benefit, you want to say to the employee, hey, if something were to happen to you before you reach your 5 years or 10 years with me, or age 65, whatever it is, I'll pay your family the full benefit that you would have achieved should something happen. Well, now you want to make sure you have that covered, so life insurance comes into play again for that.
Right, yeah, and that's big. And then you can even do things like at a certain point, you can transfer the policy to them.
Sure.
Things like that, too. It's all kinds of different scenarios.
A lot of flexibility in terms of how you can make that asset valuable to them. There's one thing I do want to just mention to people, because as we're talking about protection and, leverage and different things like that, the one thing, too, that people should all examine and take a quick look at is disability income, too. And the reason I bring that up is that there are a lot of scenarios where I work with people, and here's the question everybody should ask themselves. If something were to happen to you that knocked you out of the saddle, say for, call it 3 years is a good acid test, right? If I was, I couldn't concentrate the way I like to concentrate, I didn't have the energy, it doesn't have to be, like a long-term care bedridden for 3 years. It could be something that takes you pretty much out of your game for 3 years. What would happen? Now, some people could have the answer. They could say, hey, I have plenty of X, Y, and Z. I could do this. I can weather that storm, no problem. Great. But if somebody says this could get a little, iffy, or this could cause some problems in my business and what goes on with my family and how I'm funding all of this, they just want to make sure that they've addressed that as well. In certain circumstances, it can even be a short-term type of solution where I'm going to own a disability policy, say for 3, 4, 5 years, because if they're also using permanent life insurance and they have waiver of premium, right, they may look at the cash value and say, hey, that premium is going to continue to build that cash value, which means I can actually start using that cash value because the premium is still being pushed in. So there are a lot of ways to it. And I'm not advocating that it has to be a disability policy with X, Y, or Z company. What I'm talking about is the actual situation. In part of your business plan, take a look at what goes on and say, if something were to happen, how is this going to work? And use 3 years. Push that. I mean, yeah, to age 65, that would be horrible, but that would be a complete shifting of the puzzle pieces, right? But for 3 years, that's really more of the financial strain time frame. Figure that out, do, quick calculation. If this were to happen, how would that be handled? And as long as they've done that they have a good solid business plan. because the one thing I will say is with business planning, the thing that life insurance and disability in the area I work in, what it provides is you're building it on a solid foundation. A lot of business owners go in and take all these risks, invest their money and start their businesses without having that foundation, which means it's built on sand. Anything goes wrong at all, it's worse. The whole thing comes down. Whereas we can take those risks and make if X happens, it's accounted for. So the structure of everything you built isn't now having big problems or greater problems than you thought. So it's just stuff like that I think is important for people to have. Again, it doesn't mean you have to buy a product. It may be that you have to change a plan or make sure you have this set up or that set up. I just ask people to account for it. Insurance it's a solution. It's a funding solution. Self-insuring is fine as long as you know what that would be and the fact that you have the capability to do it.
Right. Yeah. And that's why it's important too. Anybody, talk to a professional. Like, don't just go online and buy life insurance right on their website. You don't know what you're getting. There's a lot of different things. Speaking of, Ian, how can people get a hold of you?
So I can be reached. I'll give everybody my email address, which is ian@georgeconcepts.com. That's a great place to reach me. My cell phone is open and ready for anybody to give a call. If I can answer, I answer. If I can't, I don't. And that's basically 24 hours a day. And that's 412-969-0111. I'm sitting here in my office. I have my office line. I don't usually give people my office line because the voicemail tells them to call my cell phone. Because even when I'm in the office, I generally speaking have that on mute. So that's why I give out my cell phone. But yeah, I'm happy to talk to people about what they're trying to do and talk them through it. My methodology is education based. So if it makes sense for me to help you and, we're going to do business, that's great. But, that's not always how it ends up. And a lot of times people just get the information. And the reason I do that is because that will have them tell the next person, hey, it's safe to call Ian George. He'll tell you X, Y, or Z. And if it doesn't make sense for you to do it, you don't have to do it, right?
Yeah.
They're not going to get the, hey, did your situation change? It's not how I operate. Here's what I do. Remember what I do. Off we go.
Yeah, I'm with you too. I can vouch for Ian. Ian's a good guy.
Well,
So, hey, everybody. Hey, well, we're about out of time. Thanks for listening. Thanks for coming on, George. Or Ian. Calling you George.
That's right, Ian George. And my pleasure.
Yeah, and hey, everyone, thanks for listening. Yeah, until next time, get out there, crush it, close some deals.